The legendary investor Benjamin Graham once said, "Successful investing is about managing risk, not avoiding it." If 2022 has taught us anything, it's that risk management is necessary if you want to gain financial freedom and retire early. Your portfolio needs to be focused not only on return, but also on risk and potential downside. This is extremely important to find companies that are safe, reliable, and growing. We want to see healthy balance sheets and a stable track record of dividend growth. In this video, we will discuss my favorite safe dividend stock with over a 7% yield that you can rely on. We will discuss the stock mentioned and why I'm bullish on it, my monthly portfolio update, and be sure to stay until the end because I'm going to tell you which top stocks I'm buying heavily in August. Safe dividend stocks are like having your cake and eating it too. You get monthly or quarterly passive income, and you get capital appreciation from the stock price. If the price goes down, the dividend yield goes up. While I do enjoy the growth and safety of 1 to 3% dividend stocks, I personally prefer higher yielding companies because I can reinvest more money into my portfolio. With a higher yield, you receive higher cash flow, which can compound quickly. If I can find a high-yield safe dividend grower, I am happy to research further. EPD is the safe dividend stock with a 7% yield that increased dividends. Enterprise Products Partners, ticker symbol EPD, is one of the largest midstream oil and gas companies in North America. This company has a massive network of pipelines that spreads more than 50,000 miles and connects to every major U.S. shale play. EPD has a large storage capacity of 260 million barrels of liquid and 14 billion cubic feet of natural gas. EPD is one of the largest MLPs globally with a market cap of $57 billion. MLPs, or Master Limited Partnerships, are unique investments that combine tax benefits of limited partnerships with the liquidity of common shares. They are organized as publicly traded partnerships, or PTPs. To qualify, a firm must earn 90% of its income through interest and dividend payments relating to natural resources, energy, commodities, or real estate. A huge benefit of owning MLPs is their benefit from taxes. Taxes are passed down to shareholders who must fill out a special K-1 form for tax purposes. This means lower cost of capital for the company, and dividends are not double taxed, which is great. With an MLP, investors receive more cash payments than the amount on which they are taxed, creating a nice tax deferral. Taxable income is only often 10 to 20% of dividends. Another benefit I love of MLPs is it is specifically designed to generate cash flow to shareholders. EPD has a high yield at a current 7.92%, which was increased by 2.2% on July 7th to 47.5 cents per share. MLPs can offer attractive yields because 80 to 90% of distributions are often tax deferred. With lower cost of capital, EPD is able to maintain more capital for future products and remain competitive in the sector. One reason I love owning this stock is its long-term, steady, and consistent contracts, which help forecast solid cash flow. Almost 80% of its contracts with shippers have been extended for 15 to 20 years. EPD is well positioned to create more cash flow from under construction capital projects worth $4.6 billion. When looking for safe stocks in the energy sector especially, we need to look at how well the company has done throughout recessions and cycles. During 2019 and 2020, when oil prices plunged due to decline in demand, EPD's distributable cash flow only fell 3%, making this an impressively resilient company. Even more, Enterprise is well diversified, owning pipelines, storage, transportation, assets, and refineries. It's important to look at profitability when researching a reliable company. We want to see net income and revenue increase over time. Looking at a 5-year chart, we can see EPD is getting over the 2019-2020 hump cycle, but revenue is back on track at an all-time high. Annual revenue for 2021 was $40.8 billion, which is a 50% increase from 2020. While revenue is a bit cyclical, the 10-year net income shows an impressive uptrend since 2009. Net income for 12 months ending in March 31st, 2022 was $4.55 billion, up almost 22% year over year. Another huge metric to look for when finding reliable companies is how much debt they have. This is extremely important because as shareholders, we want to see management being conservative and not being highly leveraged to produce more cash flow for our pockets. A highly leveraged company could eventually fail, and as a shareholder, you would be left holding the bag. EPD has a long history of being conservative, with its balance sheet being one of the strongest in the sector and one of the lowest debt ratios in the sector. Debt to EBITDA ratio has decreased from 4.79 to 3.58 since 2009, showing management continues to lower debt. Now let's look at the dividend. EPD has paid and increased dividends for 22 years consistently, and even raised its dividend during 2019 and 2020. This proves the company values shareholders, and while we want to see a reliable balance sheet, we also want to see consistent and growing dividends to make sure our money grows above inflation. EPD paid 68 cents per share in 2013, 37 cents in 2015, 41 cents in 2017, 43 cents in 2019, and currently yields 47 cents per share. Looking at its 10-year dividend growth rate, we can see a nice, steady uptrend. It increases dividends every year at an annual average rate of 5.92%, meaning the dividend doubles every 12.1 years. It has a payout ratio of 81.96%, which means the dividend is safe and sustainable for this MLP. As for the future of EPD, Q2 results just came out with the announcement of expansion into the Delaware Basin with 3 organic growth projects. This includes 2 natural gas processing plants and the expansion of the company's natural gas liquid pipeline system. Enterprise will be able to produce a total of more than 275,000 barrels per day, or BPDs, of capacity with completion in the first half of 2024. The basin is the driver for U.S. production growth of crude oil, natural gas, and NGLs, or natural gas liquids, that support increasing energy demand, especially during the geopolitical crisis with Ukraine. Management says these projects are a great opportunity to increase revenue while returning equity to shareholders. Q2 EPS came in at 64 cents, beating the 1 cent estimate, and revenue beat of $16.6 billion versus an estimate of $4.1 billion. So they handily beat estimates. EPD also saw a record level of gas pipeline volumes and record distributable cash flow of $2 billion. Overall, Enterprise beat estimates and had record volumes due mostly to its gas processing and octane enhancement businesses. Despite what you may have heard in the media, demand for oil and gas is expected to increase 18% by 2040. EPD expects significant growth in energy forecast as the population is expected to increase by 1.8 billion by 2050, with growing developing energy needs across the globe. EPD and other U.S. oil and gas companies will be the first in significant carbon capture projects and have already begun implementing them. So, while EPD looks for alternative energy sources, oil and gas demands will continue to grow as well. With a strong balance sheet, safe and consistent growing dividends, and a record quarter, EPD seems to be a good company to own, and while the PE ratio seems to have recovered from 2020 lows and is now back to normal, if you are willing to hold EPD for the long term and buy on dips, the dividend yield may provide consistent passive income. While this is not financial advice, I believe EPD is a buy and hold forever stock that you can feel confident owning. The legendary investor Benjamin Graham once stated, "The true investor will do better if he forgets about the stock market and pays attention to the dividend returns and to the operation results of his companies." While the market seems to be recovering a bit, investors may feel enticed to FOMO into higher risk assets, but true wealth generally comes from finding great companies at great prices. I personally prefer to receive cash flow on a monthly or quarterly basis in the form of dividends from my companies to help hedge against a bear market. When the market rallies, it's more important than ever to stick to your own plan and not chase a stock's price. I'm incredibly excited to share with you how much I made with my high-yield dividend portfolio on M1 Finance in the month of July. As a disclaimer, this is one of 10 portfolios I have, and of course this is not financial advice. I just wanted to share this with you in hopes of instilling a bit of motivation to start or continue investing your own way. We will discuss the overall portfolio and holdings compared to the S&P 500, how much I made in dividends in July, and what I'm buying for August. This is an interactive invest with me, so feel free to pause this video and get my free monthly dividend tracker, link in the description below, so you can see how well your dividends are performing. I update this Excel sheet each week based on what stocks you want to see. So comment below what stocks you are bullish on for August, and I will add them to the tracker. I'm so excited because we are finally over the $50,000 mark for this high yield dividend portfolio. Overall, the portfolio is now at $51,201.88, which is down 11.93% yield to date. This is beating the S&P 500, which is down 13.46%. Total earned dividends are $3,219.77, with QYLD at $1,288.91 and JEPI at $811.37. This month, I made a lot of changes. If you've been following me, you know I am currently rebalancing to ideally have 50% of the portfolio in high-yield companies and 50% into dividend growers. Last month, many stocks I had on my watch list reached below my buy target, and I have been slowly trickling into dividend growth companies with excellent balance sheets and a great track record of resilience against recessions and bear markets. It's incredibly important to me to manage risk and preserve capital, so I want companies where management is conservative and rewards shareholders. If you would like to check out a dividend grower that I love that's on my watch list, check out the dividend in the description below for why I'm bullish on Costco, ticker symbol COST. My main holdings in this portfolio are income ETFs. QYLD is a cover call strategy that tracks the NASDAQ QQQ. Main holdings mostly include large cap tech growth companies like Apple and Microsoft. It offers a yield of 11.88% and pays monthly. I am currently at 25% exposure, so I'm just holding and will add to other positions. Next, I have JEPI, JEPI, which is the JP Morgan Equity Premium Income ETF. This fund is relatively new, but I love the reduced exposure to market volatility. This fund finds low-risk stocks and combines this with options that flexibly adjust with the markets. It has a high yield of 7.35%. I have a 22% exposure, and I am a long-term holder of QYLD and JEPI. I am not adding to either position. I have been using these funds as kind of like cash machines to find undervalued dividend growers. Next, we have Newsy, which has been very disappointing, and I am slowly reallocating into Devo and XYLD. I have 5% exposure in Main Street Capital, ticker symbol MAIN, MAIN. This is a BDC in the housing sector that recently increased their monthly dividend to 22 cents per share, creating a 2.3% increase for October dividends. Maine has been paying dividends since 2007 and has a 10-year dividend growth rate of 3.96%. This means the dividend doubles every 17.9 years. The yield is 6.10%. While I absolutely love this company, the stock price is a bit too high for me to continue to add. Instead, I am looking to buy more STAG and STORE. STAG, STAG, recently announced FFO, or funds from operation, increasing 7.7% to 54 cents in Q2. Revenue increased as well at 17.2% year over year, and net operating income increased 4%. Shares fell 20% during the first half of the year because its largest tenant, with 3.1% exposure, which is Amazon, announced it had too much industry space and would sublease 30 million square feet to others. While this may seem bad, when looking at the details, we can see Amazon is actually trying to upgrade its space and cut down on shipping costs. It has a 4.6% yield. STAG is a big beneficiary in e-commerce, which I believe will flourish in the future. I will be buying more at these prices in the coming months. Warren Buffett's favorite store capital, STOR, is also a REIT that I will be buying more of in the coming months. It has a well-diversified portfolio of almost 3,000 properties, with each customer at less than 3% exposure. This means it is well-diversified to withstand recessions. One thing I love about STOR is its long-term contracts. This allows you to understand the cash flow of the business for many years. Weighted average lease term is 17 years. STOR has a 5.1% dividend yield with a 6.1% dividend growth rate. I am definitely buying this one. I have some index funds as well, and then a 0.8% exposure into ticker symbol ABR. Arbor Realty is a well-diversified nationwide REIT, headquartered in New York, that manages a multi-billion-dollar portfolio. Asset classes are mostly multifamily and include self-storage, land, office, hotel, healthcare, and student housing. It recently announced a dividend increase to 38 cents per share, which confirms its 8th consecutive quarter increase. This increase represented a 27% increase over that span. ABR very recently dropped in shares after announcing an upsized offering of $250 million of 7.5% convertible senior notes due 2025. We need to talk about this. The stock plunged 7%, so I decided to buy more. Unlike a traditional offering, this new convertible debt is simply replacing the convertible due in the next 30 days. They are not generating new capital, and instead this debt will be used to buy back convertible due this year. So remember, the details are what's important here, as this is a great buying opportunity. The dividend yield is 10.2%, and they have a long track record of consistent dividends. I am buying more on dips. Dividend growers that I have been buying are EPD, MO, BEN or BEN, trow or T. Rowe Price, ET, and Simon Property Group, ticker symbol SPG. Moving to the dividend tracker, I am adding whole shares only. This shows how each stock is performing as well as ex-dividend date and payout date. Let's add 3 more shares of STAG that I bought this month. This automatically shows me a total profit of $3.78 and an annual income of $91.98. Let's add 1 share of Mo because I bought 1 more this month. Let's add 1 share of Store and 1 share of ET, which I wanted to buy before the ex-dividend date coming up this week. It has a share price of $11.19 currently, and my average is $11. Copy and paste the cells below to get your stock filled automatically. That brings my total annual dividends up to $4,798.10. My goal is to get to $1,000 per month in dividends, so I'm looking for a total of $12,000 annually. Now let's track monthly dividends to see how much I made in July. I go to Activity and filter to Just Dividends. Since I have not received my dividend statement for July yet, I'm just going to add these together. Going back to the tracker, we can see the monthly charts. While I was expecting this month to be a bit lighter, I was pleasantly surprised that I made $462.97 in dividends. The charts also auto-generate once I add it to the month. While it is lower than the last month, I'm happy with the upward trajectory. This portfolio is going in the right direction as I had my highest month in dividends last month. I have that video linked in the description below for my June portfolio update. For the month of August, my top stocks to buy are Store, STAG, EPD, MO, trow, Starbucks, SBUX, SPG, Target, ticker symbol TGT, Lowe's, ticker symbol LOW, and BEN. I will add to these names throughout the month as these are great companies with well-established track records of growth and great dividends. Let me know what stocks you are buying this month and which stocks you would like me to add to the Excel spreadsheet. As always, this is Supergirl Investor here to save the world and make you wealthy. Please make sure all parents are in yachts by 2025. I love each and every one of you. Please like and subscribe for these portfolio updates. And if you have anything else you would like me to discuss as far as investing goes, please let me know in the comments below. Have a happy and safe week. Bye everyone. Bye future millionaires.